that would allow us to manufacture and export that manufacturing is. So the pendulum is swinging back a little bit. And for all these reasons I just went into, that's why BOA is long bonds, long international stocks, and long gold. Before we do gold, long bonds, he's been saying that forever. He doesn't think it's going to go below 4%, though. So I think he's long bonds because he's not long stocks. Long international stocks, I'm saying this to you as an American, speaking to an American, that means not long US stocks. That means selling US stocks and buying international stocks. That means that's what his clients are doing. And that means, to use the word degrossing. You may sell one share of US stocks and buy one share of European stocks, but net you have dollars left over. And some of those dollars are going into treasuries, and some of those dollars are going into gold. Now, he hasn't said this before. He's got many reasons to be long gold, but now he's talking about gold because the US dollar is in a bear market. So I don't know if it's technically in a bear market, literally technically, not just throwing a word out there. But certainly I've been bearish for a while. And that's his reason to buy gold. Now, that's his reason this week. If you want to tie this together, if you're long gold because the US dollar is in a bear market, then you're saying that the gold dollar correlation is strong again. And if you're saying that the gold dollar correlation is on your radar again, because it hasn't been on anyone's radar in several months, then what you're saying is this buying is coming out of the US. That's ETF buying, right? So for this to be right, you need Americans to buy gold because the dollar is getting weaker. You need Americans to buy gold because they fear inflation. There are contrary opinions out there, but that's what tail of the tape is about today. All right, the price is right. Big U.S. consumer spending aided by big U.S. equity gains. Household wealth equity rose. Well, equity wealth rose 9 trillion in 24 to 56 trillion. But using BMA private client equity data, we estimate U.S. household equity wealth could fall 3 trillion in Q1 24. Now, when he says we estimate, I don't want you to think that's a guy guessing. That's a guy who's got data before it's official. He's putting it together. He's doing a little bit of an extrapolation, and you get the chart we see on the right. That red line reflects where he thinks U.S. wealth will be in 20 days. It's not published until it's over, but he's extrapolating. And that's a pretty significant drop. I can't make the chart any bigger right now, but you get the idea. All right. So that section covers the point that I made in the summary about the wealth effect and fiscal spending all being reasons for stocks to be higher, and with stocks higher and the wealth effect all being reasons for people to spend more. Now, this last part here, U.S. fiscal monetary trade policy, currently hawkish, not dovish. U.S. yield curve set to invert. Now, mind you, this came out after the FOMC, right? So this is a Thursday to Friday report. So for him to say this, even though Powell really backed off on QT, is saying something. He's saying that the Fed is hawkish and the trade policy is hawkish, and it's a slowdown. And he also thinks, I know he thinks this because he said it before, he also thinks that there's little chance of the Fed easing because they're still worried about inflation. And because of all this, by the way, this is recessionary. Okay? And this U.S. yield curve set to invert is recessionary. Okay? Just briefly, before we go into the yield curve was inverted before, what happened? Well, in a normal environment, we've covered this before. There's charts all over our post from earlier on. When a yield curve inverts, it's recessionary. What many people don't talk about is why it's recessionary. It's recessionary because if a bank has to give you 5% and it can only loan out money for 4%, simplifying it, then they're not going to yield money out. And that will slow the economy down. The velocity of money slows down when money markets are getting more than 30-year bonds. That's why an inverted yield curve is recessionary. Now, why would you tolerate a yield curve being recessionary? Well, you would tolerate a yield curve being recessionary because you're more concerned about fighting existing inflation than you are worried about potential recession. Okay? So remember when the Fed raised rates before? The idea was raise rates, get the yield curve inverted, slow the flow of money down, and you'll probably have a little bit of a recession or a big recession. The point being is fighting inflation was more important than risking recession back then. Now, going to back then, which is, 2 years ago, yield curve did invert, but we did not get a recession. Now, this is hindsight, but the yield curve inverting and not getting a recession was probably because the fiscal spending was so big that the Fed couldn't raise rates high enough to slow it down fast enough. There was still too much money out there, and it took a lot longer. Now, this time, if that money is